Britain likes to think of itself as a world financial powerhouse. The Square Mile in London, glass towers of Canary Wharf, traders shouting across desks, bankers moving billions with a few keystrokes. This is the image of modern Britain projected across the globe. But behind the glittering skyline, the UK economy has become dangerously lopsided. It has turned into what many economists now call a financialized economy, one where finance is not just a sector, but the dominant force shaping how businesses, politics, and even households operate. This is the financialization curse, when an economy becomes addicted to finance, when the pursuit of quick profits through speculation, debt, and asset bubbles takes precedence over making and building real things. And for Britain, this curse has come at a staggering cost. Let's break it down. Financialization is what happens when finance stops being just one part of the economy and starts running the whole show. It's when banks, markets, and financial motives grow so powerful that they dictate how companies, households, and even governments behave. Instead of investing in new factories, research, or workers, corporations increasingly chase shareholder value through buybacks, dividends, mergers, and asset trading. Households, meanwhile, patch the gap between flat wages and rising costs with debt, credit cards, mortgages, student loans. And governments, fearing the wrath of markets, often design policies to keep investors calm rather than communities strong. The United Kingdom is perhaps the clearest example. Once the workshop of the world, Britain's empire of coal, steel, textiles, and shipbuilding gave it unmatched industrial power. But by the late 20th century, much of that base had collapsed, and finance rushed in to fill the vacuum. The turning point came in 1986, with the so-called Big Bang reforms under Margaret Thatcher. Stock markets were deregulated, foreign firms were invited in, barriers between different financial activities were removed. Overnight, London transformed. The city became the beating heart of global finance, attracting banks, insurance giants, and investors from every corner of the world. By the 1990s and 2000s, finance was not just another sector. It was the sector. According to the Office for National Statistics, by the mid-2000s, financial services made up more than 10% of Britain's GDP and an even larger share of corporate profits. At its peak, finance generated tax revenues of around £70 billion a year. It seemed like a golden age, but in reality, the foundations were brittle. The UK was stacking its economic future on speculation, leverage, and credit. Then came 2008. When Lehman Brothers collapsed in New York, the shockwaves slammed straight into London. British banks were overexposed, over-leveraged, and overconfident. Royal Bank of Scotland had ballooned into the largest bank in the world by assets worth £2.2 trillion, 10 times the size of the UK economy. When it failed, it became the biggest corporate collapse in British history. The government had to step in with a bailout that eventually cost taxpayers over £137 billion in loans, guarantees, and equity injections. The city, once celebrated as Britain's crown jewel, suddenly looked like its Achilles heel. But here's the irony. While the crash devastated ordinary households, lost jobs, repossessed homes, frozen wages, the financial system itself was quickly propped back up. The Bank of England slashed interest rates and launched quantitative easing, injecting trillions into the system. Asset prices recovered, stock markets surged, and property in London became a playground for the global rich. The curse deepened. Finance had failed, but finance was saved. How does financialization warp the real economy? First, the hollowing of industry. Britain was once an industrial powerhouse, famous for producing cars, ships, steel, and textiles that were exported across the globe. In the 1970s, manufacturing contributed close to 30% of the nation's GDP and provided millions of stable jobs. Today, that figure has shrunk to barely 10%, marking a dramatic decline in the sectors that once built Britain's middle class. In their place, finance has risen to dominate the economy. But unlike industry, The wealth generated by finance is concentrated in London and a handful of financial hubs. Entire regions, the Midlands, the North, and much of Wales, have been left behind, stripped of secure, well-paying work and locked out of the prosperity clustered around the City of London. Second, housing as an asset, not a home. Perhaps the most visible and painful effect of financialization is in housing. What was once understood as a basic human need, a roof over one's head, has increasingly been transformed into a financial asset to speculate on, trade, and leverage. Since the 1990s, UK house prices have skyrocketed, rising more than fourfold. In London, the surge has been even sharper, with prices climbing over 500% since 1995. This isn't just down to supply and demand. It reflects a system where banks flooded the market with easy credit. Overseas investors treated British property as a safe deposit box, and government schemes like Help to Buy pushed demand even higher. The consequence is stark. Younger generations find themselves locked out of ownership, while wealth concentrates in the hands of existing property owners. Housing, once a ladder of opportunity, has hardened into a wall of exclusion. Third, debt dependency. For ordinary households, the story is one of mounting pressure. Real earnings have inched forward only slightly over the past 2 decades, and when rising prices are factored in, the gains feel almost invisible. At the same time, household debt has ballooned to more than £1.8 trillion. Mortgages make up the largest share, but credit cards, car loans, and student debt weigh heavily too. This borrowing is not about luxury or indulgence, it is about survival. Families take on debt to secure housing, to cover the cost of education, or simply to keep pace with everyday expenses such as food and energy. Consumption has been sustained, but only by binding households to an ever-tightening cycle of borrowing that substitutes for genuine income growth. Lastly, shareholder capitalism. Corporations, too, have been reshaped by the logic of finance. The traditional model of reinvesting profits into workers, research and development, or long-term infrastructure has steadily eroded. Instead, the dominant priority has become rewarding shareholders as quickly and generously as possible. In the UK, this pattern is especially stark. FTSE 100 companies routinely channel more money into dividends and stock buybacks than into capital investment. Such decisions might please investors in the short run, but they come at a cost. By sidelining innovation and workforce development, firms undermine their own long-term competitiveness. This culture of short-termism is one reason Britain's productivity has remained stubbornly weak since the financial crisis, leaving the economy less dynamic and less resilient. The financialization curse has produced a society marked by deep and growing inequality. On one side are the clear winners, the big banks, asset managers, and hedge funds that thrive on speculation and global capital flows. Property investors, particularly those who own multiple homes, have seen their wealth multiply as real estate prices soar. And at the very top, the wealthiest 1% continue to benefit disproportionately, with fortunes tied to stocks, bonds, and rising property values. On the other side are those left behind. Young workers face insecure, low-paying jobs, while the dream of home ownership drifts further out of reach. Entire regions outside London see little of the wealth generated in the financial hubs, their economies stagnating as opportunities vanish. Meanwhile, the public sector shoulders the cost of bank bailouts only to be told austerity is necessary. The result is a two-tier economy, one that thrives on capital and another that struggles to survive on. Here's the hardest truth to confront. Finance doesn't just shape the economy, it shapes politics as well. Successive governments, whether left or right, have consistently feared upsetting the City of London. The reasoning is straightforward. Finance brings in billions in tax revenues, supports a lucrative cluster of high-paying jobs in the capital, and props up the asset prices that reassure millions of middle-class homeowners. Yet this dependence has distorted policymaking. Too often, decisions are crafted not with ordinary citizens at the center, but with financial markets as the priority audience. Austerity in the 2010s is a striking example. Sweeping cuts to welfare and public services were imposed, even as quantitative easing pumped trillions into the system, inflating stock markets and property values. Housing policy tells a similar story, with schemes like Help to Buy increasing demand and pushing prices higher rather than making homes more affordable. Britain's future remains tied to finance, making escape feel all but impossible. Is there a way out of the financialization trap? Economists remain deeply divided. Some argue that the UK must rebuild its productive base by investing heavily in green industries, advanced manufacturing, and regional development to create jobs outside London and reduce dependence on finance. Germany, with its enduring industrial strength, is often cited as a model worth emulating. Others call for tighter regulation of the financial sector itself. Measures like taxing speculative trades, cracking down on property speculation, and channeling credit toward productive investment rather than asset bubbles. Yet, none of this can happen without real political courage. In a nation where the city wields immense influence and millions of homeowners vote with property values in mind, change comes slowly, if at all. Financialization is not just an economic quirk, it is a force that shapes Britain's future. By locking in inequality, it makes social mobility increasingly difficult and ensures that opportunity is far from evenly shared. It deepens generational divides as younger people find themselves excluded from the wealth that property and asset ownership has delivered to older generations. It also leaves the economy more fragile, because when crises strike, a system so heavily weighted toward finance is among the most vulnerable. Beyond economics, it distorts democracy itself, bending policy toward the interests of capital rather than the needs of communities. Perhaps most dangerously, it fosters complacency. London's glittering prosperity hides the mounting struggles elsewhere, but economies built on speculation rather than production inevitably face reckoning. Britain's financialization curse is best understood as a dangerous dependence, one that provides quick bursts of wealth and prestige, but steadily erodes the foundations of the economy and society. The immediate gains of tax revenue, high property values, and London's global standing mask the deeper damage. An economy stripped of industrial strength, a workforce trapped in stagnant wages, and a society split between those who live off capital and those who struggle on wages. Unless Britain finds the courage to rebalance, it risks becoming less a story of resilience and more a cautionary tale of a nation that confused speculation for genuine progress, mistaking inflated wealth for true prosperity, and leaving future generations to pay the price. Thank you for watching.